Good afternoon, boys and girls. It's a weekly wrap up for Friday, March 18th, 2022. I hope everyone's had a fantastic week. Pretty good week here in Colorado. We got a pretty big snowstorm yesterday. I got to spend about an hour clearing some very wet, heavy snow off off my driveway and cars. So that was a lot of fun. So I got my PT in that way. Came inside and stripped down my snowsuit, and I was soaked to the bone. So that was fun. But like I said, hope everyone else out there is having a good day. And it is March Madness time. I have see who's playing right now. Miami and USC is on my television. And somebody just took an elbow to the face. They've replayed it in slow motion about 10 times. But Cougars are playing tonight, 7:20 Mountain Time, 8:20 Central. Not sure the channel. Check your local listings. I think it's on one of the Turner stations. If you're on DirecTV, it's probably the 240s somewhere. So, all right. Well, let's go ahead and take a peek and see how the indexes did today. Let's make that a little bigger. So for those of y'all watching at home, too large. There you go. All right. Dow Jones was up again today, up 0.8%, closing at 34,754. S&P 500 was up 1.17%, closing at 4463. NASDAQ up 2.05%, closing at 13,893. Small caps were also up again today, up 0.86. The VIX was down again for either a third or fourth day, down 7.01%, closing at 23.87. So pretty good day here domestically. Let's take a look at the other Americas. Canada was up, Brazil up. Mexico is up, getting into Western Europe. The European markets, all green. Let's see, we got one that was flat. Let's see what that was. Portugal. But all the way down to the Russian indexes, everything was green. Russians markets were still closed. Let's see here. We got two down markets. Poland and Hungary were down 1.22 and 1.48 respectively. And then we get into the Asian markets, nothing but green. The only Chinese market that was down was I guess it's the Hong Kong market. It's not technically China. Was down 0.41% and kind of mixed in some of these smaller exchanges in Asia. So, but for trading day, March 18th looks pretty good. Other than a few, blips here or there. Looks like we had a pretty green day. All right. Well, let's take a look and see how the indexes here domestically did for the week. The Dow Jones was up 5.26%. S&P 500 was up 6.19%. NASDAQ up 8.76%. The tech stocks have taken a beating over the last little bit, so it's not surprising to see it jump. The Dow Utilities finished up 0.22%, and the Dow Transports were up 8.04%. So all in all, not too bad of a week. Let's take a look at the trend line right now for the Dow Jones. We can see that going back to the beginning of January, we've been on this slow, steady trend where our highs have been a little bit lower each time we reach a peak. So be curious to see next week, because this is today right here. Are we going to go through this line of resistance, or will we continue to, or will we see a retracement and have the lows continue to trend lower over the same period of time? So you can see we're kind of in this little trend line right here going in a downwards direction. So will we break it next week, and will things turn back around for the short term, or will this trend continue into next week and through the end of the month? So we'll see. It's kind of building a little predictable pattern here. But, obviously trends are made to be broken. So we'll see what happens long term. All righty. So let me remove that. And let's fix that. All right. Well, let's look at the economic data that came out this week. Initial jobless claims came in at 214,000. Let me see if I can make that a little larger. Still hard to see. There we go. All right. Initial jobless claims came in at 214,000 against a forecast of 220, so slightly under the forecast. Last week's numbers were revised up from 227 to 229, still above last week's forecast. Continuing jobless claims came in at 1.419 million. Forecast was 1.485 million, so below forecast. And again, looking at the longer term trend of those on continuing claims, we've gone from over 2 million in November to less than 1.5 million here in the end of the first quarter of 2022. So again, that is looking for the positives. This is certainly very good. I would like to see the number of employed Americans above where we were 2 years ago. To me, that'd be a really good sign. But the fact that the jobless numbers look good is still pretty positive. All right. The U.S. Producer Price Index year over year came in at 10%. Forecast was 10%. So you can see going back over the last, better part of a year, we've gone from about a 4 number up to a 10% number. So, prices are continuing to rise, on the producer side. So, I know that inflation has been a big subject for a lot of folks. If you've been watching the financial channels or maybe even the regular, national news channels. I don't watch them, so I couldn't really tell you what they're talking about. I breeze through the headlines, but I don't really give a damn about, what CNN or Fox's opinion of anything is. Retail sales year over year up 17.62%. So again, a good number. It looks like the sales numbers on the retail side look pretty good. But how much of that is higher costs? Leading to a higher number versus the actual amount of goods sold. So it is a tough thing. All right. Housing starts came in at 1.769 million. The forecast was 1.69 million. So nearly 100,000 higher. So again, strong trend in the housing starts market. Industrial production year over year came in at 7.45. So the previous number was 367. I'm sorry, 364 was the previous. So, but yeah, again, production wise, it looks like the supply chain, a lot of the supply chain woes have improved. So from that aspect, things do look pretty good. Existing home sales came in at 6.02 million. Forecast was 6.1. So a little bit of a pullback. That could be just due to a lack of inventory. There's a lot of things that could be involved there. So not a huge drop. So housing still looks fairly strong, from the building aspect and then also the existing sales. All right. The Baker Hughes rig count, we're at 524 rigs that are operational right now. Last week's number was 527. So it looks like we dropped off 3 rigs. I know I've talked a lot about, I'd like to see us get above 600 and closer to that 600 number. I think that would reduce a lot of strain off of oil and gas prices. But I did cover, I think it was last Friday, maybe. You'd have to go back and look through my videos to see the article. But yeah, I think it was last Friday where, the reason that, domestic oil drilling has not, boosted up, nearly back to the levels we were at 2 years ago. A lot of that has to do with the regulations that the oil and gas companies are worried about that will be coming down the pipeline with the current administration. So hold on one second. Sorry, had to get a drink of water. Had a bit of a frog in my throat. But like I was saying, it appears that, just from, the articles I've read and, what's coming out of these big companies is that, they're worried about, increased regulations with, having the Dems in charge of things right now. That may change in a few months with the next election, but Again, it appears that those that make the decisions regarding, oil exploration and such, have been, slow walking it. Basically, they're not in a huge rush to, get those wells back online. So, all right, let's see here. Let me shrink that down. The SM got 3 articles I want to cover before we wrap things up today. First one, S&P climbs as tech continues comeback. This is written by Yassine Ibrahim from Investing. The S&P 500 climbed Friday, led by tech as the broader market shrugged off Federal Reserve officials calling on the central bank to get even more aggressive on rate hikes that may fear could slow the economy too much. Tech continued its comeback to remain on course to snap a 2-week losing streak as investors continued to pile into big tech. Meta Platforms led the pack up more than 3%, followed by Amazon, Apple, Alphabet, and Microsoft up more than 1% each. Chip stocks were also in the ascendancy, supported by nearly 6% gain in NVIDIA as the chip maker extended its rally for a 4th straight day. Growth sectors of the market, like tech, were also helped by falling interest rates, even as Fed officials urged the central bank to do even more. Federal Reserve Governor Christopher Waller on Friday called for the Fed to consider more aggressive rate hikes and get the balance sheet reduction underway to make a dent in the pace of inflation. The remarks arrived on the heels of remarks from St. Louis Fed President James Bullard, who suggested the Fed hike rates by 50 basis points several times this year to push the central bank's rate to 3% by year end. I like that idea. That would be well above the Fed's current outlook for rates to reach about 1.9% by year end. Industrials struggled to join the broader market rally, pressured by weakness in defense stocks and a slump in FedEx. FedEx fell more than 5% after reporting quarterly results that missed both the top and bottom lines as higher labor costs hurt results. Defense stocks, including Huntington Ingalls Industries and L3Harris Technologies, were down more than 2% as investors appeared to be pricing in the prospect of progress on Ukraine-Russia peace talks that could prove key to ending the war. Yeah, those defense companies, they do not like calm and peace in the world. They'd much rather build missiles and more F-18s and F-35s so that they can get rich at the expense of a lot of murder and death. So, and yes, I'm including our government in the murder part. Stocks are expected to have a volatile end to the session as triple witching when stock options, stock index futures, and index options expire on the same day. Usually triggers wild moves as investors move out of old positions and take new ones. The rally in the broader market has stoked debate on whether this is the start of a bottoming process or further downside lies ahead. Market technicians, however, urge caution on reading too much into the rally as options expiring tends to muddy market movements. Technical indicators, including volumes and market breadth, have yet to improve significantly to signal that the market is establishing a bottom. If this is the beginning of something more broad-based, you'd want market breadth conditions to improve meaningfully, volume being strong as the price is going higher. But I think the jury's still out on that. End quote. Chief market strategist David Keller at Stock Charts told investing.com in an interview on Friday, quote, "At this point, I'm still thinking it's a tradable bounce within a downtrend," Keller added. Kind of like what I was talking about with that downward trend of the S&P 500. All right. Next article, more to do with the Fed. Fed policymakers say dramatic rate hikes may be ahead. This is written by Howard Schneider and Ann Safir. Two of the Federal Reserve's most hawkish policymakers on Friday said the central bank needs to take more aggressive steps to combat inflation, and 2 others said they would be open to it, one of whom just 6 months ago envisioned a 2020 with no rate increases at all. I wonder if you can guess who that was. It still could be that the Fed only needs to raise rates modestly above neutral, Minnesota Fed President Neil Kashkari said in an essay published on the regional Fed's bank's website, in which the former Dove said he wants to raise rates to 1.75 to 2% this year. But he said the economy may have shifted to a high-pressure, high-inflation equilibrium, requiring the Fed to act more aggressively and bring policy to a contractionary stance in order to move the economy back to equilibrium, consistent with our 2% inflation target. Which way the Fed needs to go will depend on what economic data shows over the course of the year, he said. Fed officials hiked interest rates this week for the first time in 3 years and signaled that more rate increases are coming as the central bank removes the support provided during the coronavirus pandemic and works to tame inflation at 40-year highs. Most Fed policymakers see rates rising next year to a level that would restrict growth, forecasts show. But exactly how fast or high rates should rise is a matter of debate. Earlier in the day, Fed Governor Chris Waller said economic risks around Russia's war in Ukraine led him to vote in favor of a 0.25 percentage point rate increase at this week's meeting rather than dissent in favor of the larger half-point increase he had been advocating. Quote, the data is screaming to us, go 50 basis points, but the geopolitical events were telling you to go forward with caution, quote, end quote, Waller said on CNBC. But in the months ahead, Waller said he would favor a series of half percentage point increases to front load tighter policy and have a quicker impact on inflation. St. Louis Fed President James Bullard, who dissented on this week's action in favor of a half point increase, said on Friday that officials should raise the Fed's overnight lending rate to more than 3% this year to catch up with the elevated inflation. After Wednesday's move, the Fed's target rate is now 0.25% to 0.5%. He said he not only favored a half-point increase this week, but rate increases at a pace that would require half-point increases at 5 of the Fed's 6 remaining meetings this year. Quote, the U.S. economy has proven to be especially resilient, end quote, against the pandemic and geopolitical risks, Bullard said in a statement explaining his dissent. With inflation by the Fed's preferred gauge running above 6%, triple its 2% target, Bullard said more Fed action is needed to prudently manage the U.S. macroeconomic situation. Though most of the Fed officials see 6 more quarter-point rate increases this year, 7 of the Fed's current 16 policymakers, like Bullard, think rates should go even higher by year's end. To counteract inflation, Waller said the central bank should pack more of that into the next few rate hikes. Just do it rather than just promise it, he said. While we do not specify where he would like to see the target federal funds rate end of the year, Waller said he would prefer to get above 2% or 2.25% level he sees as acting neutrally for the economy. Half of the Fed policymakers see rates rising to at least 2.8% by end of next year, high enough to break economic growth in the view of most of them, projections released this week show. With rates still far from a level that would constrain growth, the rate path shouldn't drive economic decline, said a fourth Fed policymaker, Richmond Fed President Thomas Barkin. Barkin said he is, quote, very open, end quote, to a half-point rate hike if inflation accelerates or expectations move up. Hold on. If inflation accelerates, what do you mean? Could it not get, well, I mean, yes, it could get worse. But, I mean, come on. It just drives me nuts. These people are full of crap. You know, they only do what's in their best interest, it seems like. Let me jump back in because Kashkari did not address the possibility of a half-point hike, but the shift in his policy outlook encapsulates the Fed's pivot from policy designed to cushion the pandemic crisis to its current inflation-fighting stance. In September, he was the Fed's most dovish member, arguing that as the pandemic receded, inflation would cool this year without any interest rate hikes as supply chain got fixed. Workers returned to the labor force and supercharged demand for goods ebbed. Instead, inflation has accelerated well above the Fed's target. Sorry, you're wrong, Neil. You're an idiot. Supply chains have been slower to recover, and resurging pandemic in China risks continued bottlenecks. Wage growth has picked up instead of slowing, and in what Kashkari said was his biggest surprise, spending on goods remained elevated. Again, just because these people have fancy jobs doesn't mean they're smart. I mean, most of them, you know, they went to some fancy school. Somehow I'm disappointed in everyone running the show for some reason. Speaking at a North Dakota Petroleum Council event, Kashkari underscored his hawkish turn. He's saying he favors starting to reduce the Fed's balance sheet next month at a pace twice as fast as the Fed used the last time it shrank its portfolio. He said he still thinks it's possible inflation is mostly driven by supply-demand imbalance that will right itself, allowing the Fed to raise rates only slightly above the 2% he sees as a neutral level. But Russia's invasion of Ukraine makes inflation pressures worse, and continued strong household spending suggests that, quote, robust economic activity and the associated high inflation may be sustained and, in fact, might not be transitory. Really, Neil? Again, morons. I mean, everyone in government is an idiot. The people at the Fed are idiots. They create a problem. It's like the old saying: government breaks your leg and then they sell you a crutch. And then they feel like they're a hero because they provided it to you. Ugh. Anyways, all right. Last article here: why Warren Buffett doesn't buy real estate and most other investors shouldn't either. Wonder what he means by that. It's written by Kevin Vandenbos. Right. Warren Buffett's long-term outlook on investments proved successful once again this week when Berkshire Hathaway shares closed above $500,000. If there's one thing that's made Buffett one of the most successful investors in history, it's his commitment to his strategy. A countless number of new investment techniques and algorithms have come and gone over the years, but Buffett has maintained his fairly simple strategy of picking solid companies and focusing on long-term growth while somehow ignoring the noise that sends most investors into a panic. It may seem odd that somebody with such a disciplined long-term approach to investing has no interest in purchasing real estate, especially since it's what Vice Chairman of Berkshire Hathaway Charles Munger used to build his fortune. Buffett isn't opposed to investing in real estate and has invested in several real estate investment trusts, or REITs, over the years. However, he knows it makes little sense to go into the business of being a landlord. There's the distinction. Buying and managing real estate is more of a business than it is an investment. And Buffett knows that his time is better spent choosing companies to invest in than running a real estate business. Real estate is a tough business and one that needs to be scaled to comprise several properties in order to build a significant wealth. Many individual investors get into real estate with the misconception that it's a passive investment, and most eventually exit those properties once they realize what they've actually gotten into. Investing in real estate is a different story. Passive real estate investments allow investors to reap the rewards of this profitable asset class without taking on the management responsibilities. The FTSE NAREIT all equity REITs index has outperformed the S&P 500 in total returns during 13 out of the last 20 years, producing an average annual return of 13.1% versus 11.1% of the S&P 500. Many investors have turned to the private markets for passive real estate investments, have averaged even greater returns. For instance, real estate crowdfunding platform CrowdStreet has produced an average internal rate of return of 18.5% for investors on its fully realized deals since 2014. Buying and managing real estate is a business with incredible profit potential, but it's important to realize that's a business and not a passive investment. The returns realized through owning real estate as a direct result of the time, energy, and money that goes into it. While that business has been the source of many great fortunes over the years, it's just simply not a business that makes sense for most people. So I would agree. It is. I have some clients who are in the real estate business and own rental properties, and that they are a lot of work. It's not as simple as just buying a house, putting a for rent sign up, and or a vacation home, and taking bookings from realtor VRBO, and and that's it. I mean, you got to worry about maintaining it, especially if it's a short-term rental. If it's a long-term lease where someone's living there semi-permanently, you have to deal with maintenance problems, and if they don't pay their rent on time, deal with collections and things like that. So a lot of people make a lot of money off it, but you do have to understand there is a little bit of work involved. It's not like buying AT&T stock, collecting a dividend, and it's always between 30 and 40 bucks a share. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me over the weekend, don't hesitate to reach out via email or drop me a phone call. I'll be back Monday with the weekly economic update and hopefully some good news that my Cougs, woohoo, go Cougs, have won both of their games this weekend. If not, I will have a sad face. But anyways, like I said, everyone go out and have some fun. It's springtime. Hopefully it's nice and sunny wherever you're at. And we'll have a few days here of the sun being out. It's supposed to warm back up tomorrow and Sunday, and then we have another 8 to 10 inches that's going to pummel us again on Monday going into Tuesday. So I got another date with the snowblower at least one more time. So I'm very, very excited about that. So anyways, I've rambled on for 25 minutes, and I'm going to go ahead and let y'all go and enjoy your weekend, and I'll talk to you later. Bye-bye.